Hello and welcome to the Contrarian Capitalist podcast. My guest today is Dr. Nomi Prins. Dr. Nomi Prins is a geo-macro economist, founder of PRINSIGHTS GLOBal, and best-selling author of 7 books. We are going to be talking about the FOMC meeting. Don't like date stamping the podcast, but we are recording this on Thursday the 19th. Podcast is out Monday the 23rd, and the FOMC meeting was yesterday on the 18th. First of all, Dr. Nomi Prins, welcome to the show.
Well, thank you so much. I'm really happy to be here. I really love your work.
Thank you. I know that it's great to see the channel growing, and it's wonderful to be able to have a chat with you today. We'll start at the top. Why did the Fed cut rates?
Well, to dig into that, they cut rates because they recognize that though inflation isn't where they actually had targeted it to be at 2% and staying at 2%, which a number of months ago was something that Powell was very steadfast about. There are other signs of weakening, particularly in the labor market, that they had ignored, that other members, I think, in Washington, the media, and throughout really the country had pointed out and noticed. And with the weakening labor market, I think they were concerned that it would continue to weaken more aggressively. It's already, the unemployment rate's already risen from 3.7% earlier in the year to a high so far of 4.3%. It did come back to 4.2% last month, but it remains to be seen what's going to happen with that, because hiring has slowed down. The amount of jobs available per person has come down, and of course that rate has gone up. So there's significant weakening that's being seen in the labor market. And I think that was the impetus for Powell to turn around and say 2 things really that were interesting to me. One was that the economy is solid, and 2, I'm paraphrasing, is that he's watching the labor market. And it's hard to really think of both happening at the same time, because obviously weakening labor market also has economic weakening potential. And we don't have a solid economy in terms of, the Fed itself said they recommend, or they forecast a 2% growth. 2% growth adjusted by over 2% inflation is a flatline economy. I don't call that solid, but he had to, in order to get to the meat of your question, in order to cut rates and have a reason to cut rates, other than inflation has come down, which he had been looking for. But labor has weakened, but he's saying the economy is solid. So he's kind of giving them an aggressive victory lap with a more aggressive 50 basis point instead of 20 basis point cut, first cut since March 2020, so that they can basically declare victory while saying we're getting ahead of any possible problems that could happen. But don't worry, the economy's solid.
Which brings you on to my next question, and this comes from one of your fantastic articles that you recently wrote. I will put links to your Substack in the Substack post that does come out with this podcast as well. But the title was "Politics, Power, and Another Fed Misstep," and I think in there you said something along the lines of that the Fed is quite, or can be quite slow, so it's a bit behind the curve. Why is that? Is that because they're looking at data quite late, or they're just not sure about what's going on? What's your take on that?
That's really interesting, because Powell in particular uses data as the crutch to say whatever it is we do, it's going to be data dependent. Data dependent should be like his t-shirt. And as a result, most data gets processed and released after the fact. So data itself tends to be backward looking, particularly the types of data points that the Fed looks at, the larger Bureau of Labor Statistics unemployment figures, the CPI, the PPI, these are all monthly figures after information is compiled. So by definition, a data-driven approach, if you're looking at data that's at least a month old, is going to be a little bit old. But also, the Fed has been very careful, I think, since it declared inflation transitory, when it was really jumping up to 9%. It came down to 7% before the Fed started to think about doing anything, and it's come down since then. That's a kind of separate topic. But as a result, though, it was being careful. And so that's why another reason why it's behind the ball. Also, what I found really interesting, the dot plot, basically the forecast of where each FOMC member says or thinks that rates are going to be over a certain period of time, really showed a lack of kind of dissent within the ranks, as did the vote for 50 basis points. Every single but one member of the FOMC committee voted for a 50 basis points instead of 25 basis point cut. Now, compare that to the last meeting, and we didn't have any cut, right? So also building this sort of consensus internally and connecting it to the sort of political and economic environment. I don't mean political relative to the election, but just the general focus on what the Fed is doing also creates a situation where the Fed tends to be behind what's actually happening because they're just afraid of being ahead of it. Which is why it's ironic that Powell did say they're trying to get ahead of a potentially risk situation in the labor market, because they don't tend to say things like we want to get ahead of things. So again, it was a massive sort of cover up for where they're at right now.
Yeah, I did notice looking at how the markets reacted initially to, first of all, the news, so especially in gold and silver. I noticed that they spiked up. Then Chairman Powell started speaking. Then it all went downhill. And then probably what didn't help overnight was then geopolitical tensions in Israel, and that area really erased that downfall in the metals. But anyway, this isn't about Israel. This is about the Fed. Going back to that article that I mentioned, that politics of power and another Fed misstep. Two-part question here. You mentioned about the Fed putting Wall Street ahead of Main Street and a bit to do with the Basel III regulations. Now, for those people that I'm not overly familiar with what the Basel III regulations are, can you cover what they are first and then explain why the Fed is putting Wall Street over Main Street?
Sure. So back in the late 90s, really, a consortium of 28 central banks called Basel created an accord set of regulations or rules by which their financial system, so private banks, the big banks, would have to abide and have a certain amount of capital, equity capital, liquidity, money in reserve in case there were emergencies, so they could basically cover or handle their own emergencies. Over time, the sort of Basel I Accord became Basel II, and we're into Basel III right now. The Basel III suggestion was that banks increase the amount of capital they have on reserve for a rainy day, for emergencies, to not be bailed out by governments, by 19%. What the Fed and also the FDIC, other regulators in the United States, said was that, instead of doing that whole 19% increase, we want a 9% increase, which is barely above where they're at now. If you actually equate for a lot of figures in terms of how banks look at their books right now, it's pretty much not doing anything. Now, this is after 4 of the largest Wall Street banks actually failed something called their living wills. Living wills are something that came out of the Dodd-Frank Act that was passed in 2010, so 2 years after the financial crisis of 2008, that among other things said that banks have to basically analyze a series of stress tests, like what happens if unemployment spikes, if there's a massive drop in liquidity, if there's a geopolitical event that really impacts banking, losses and portfolios, etc. A bunch of basically factors, and that they would have under these stress factors enough capital to contain themselves without asking for bailouts. That was part of the living wills. Now, the interesting thing about those is that the banks actually negotiate the questions and the stress tests with the Fed anyway, so they're gaming the test anyway. But then when they put together their assessment under these stress scenarios, they failed. For the big banks failed, and they have until next year to submit new living wills and pass them. So the fact that the Fed is saying we don't need our banks to put aside extra capital, our big Wall Street banks to put aside extra capital, like the world is proposing, and the wills that we imposed upon them, for which they choose the stress tests, were something that they failed and don't have enough reserve capital to pass, just seems very, very reckless to me. So while we're all focused on basis point cuts, how much is the Fed cutting, how much are they going to cut next meeting, why, and all these arguably important questions, behind the scenes and in the sort of weeds of capital and the banking system, which central banks are supposed to monitor and regulate, particularly the Fed to the US banking system, they're sort of giving them a pass because Wall Street complained that they don't want to put extra capital aside. They're fine.
So then when I use the term when, not if, so when the house of cards comes crashing down, then do we get a repeat of what happened in 07, 08, or will something different happen?
It's an excellent question because what we've seen since 2007, 2008 is, first of all, the Fed grew its balance sheet from about $800 billion, which was actually already high, into the financial crisis. It kind of accumulated to very, very low, to $4.5 trillion within a year and a half. What does that mean? They basically electronically created money that they injected into the big banks, into the financial system in return for their treasury bonds and their underperforming mortgage bonds, because we were in the middle of a mortgage crisis. And so basically, here's some cash, like a lot of it, and we'll take your debt, which they're still holding. So that's a factor that happened after, in that magnitude, the financial crisis. The second time that factor happened was when the Fed increased the size of its book, which had dropped to about $4 trillion in the beginning of 2020, up to $9 trillion, or just under $9 trillion, because of COVID, because the banks were concerned that with the economy closing and that liquidity would tighten, and there were other policies being passed, and the Fed stepped in and basically again injected money into not Wall Street, not Main Street, but Wall Street, into the financial system in the form of more of this quantitative easing. That's come down a bit. It's just over $7 trillion right now, but that's still a lot higher. That's a huge cushion for the financial system to rely upon in case it goes into trouble. It is bigger than it was after the financial crisis. So if there is a crisis in the banking system, which I agree there probably will be, and it will probably happen in commercial real estate, distressed loans, different types of both commercial and consumer credit that revolves around offices, multifamily homes, and sort of larger construction that has leases attached to it that won't be renewed and so forth. So money won't be coming in. So that collateral will be worth less, and that will basically deflate the value of the loans, and that will require them to basically book more losses, which we're already seeing. Wells Fargo and JP Morgan, who said they have nothing to do with commercial real estate potential losses, are writing down losses. They are increasing their projections of their losses. So what they're saying and what they're doing are two different things. Can we have a crisis because of that? Yes. Will the Fed step in if that happens and print or electronically create more money? Yes. So will the crisis look like it did in 2007, 2008, where it took effectively the economy in the United States and many economies throughout the world down, where central banks around the world required dollars and required liquidity in dollars to preserve their financial systems because they were trading with US banks, those banks? It might not look like that, because since then we have all of these remedies, I say in hand quotes, that the Federal Reserve has deployed in really big magnitudes and can deploy again. There's no law in the United States that restricts the amount of printing, electronically creating of money that the Fed can do. It is technically limitless. So if there were a crisis, I believe that they would come in and increase the size of their book, inject money into the system, and really sort of try to tame it while it's happening in a way that they didn't get ahead of, let's say, before the financial crisis of 2007, 2008, which is why they don't have to worry as much about bank losses, and why they don't.
I think you've almost just answered the next question that popped into my head, which was about how that affects the banking system in the long run. After what I've taken from what you've just said is that actually it might not affect anything in the long run, because it's almost like it's on a rinse and repeat cycle. Is that a fair thing to say?
I think that's fair. What it does impact in the long run is that the banks that are smaller than JP Morgan Chase, that are smaller than multi-trillion-dollar asset size banks, the regional banks, that are facing the more acute potential losses or defaults, delinquencies from their comparatively larger commercial real estate books, they can be taken over in failure, in bankruptcy, by the bigger banks. So what can happen is banks that are focused on the Midwest or the Southeast or the Northeast, or, you know, sort of the remaining regional banks that are decent sized, but not multi-trillion dollar type banks, can really have problems ahead. They can go into crisis, they can go bankrupt. But what we have seen, even with First Republic Bank, which basically went into crisis last year, JP Morgan just took it over, you know, and they just sort of rebranded, you know, assumed their assets, assumed their customers, you know, did some stuff on their website, their technology behind the scenes, whatever, and they accumulated this bank. So there will be a shift, as we have seen in the landscape of banking. And what does that shift mean? It means that the bigger banks get bigger. And this whole idea too big to fail that we are also concerned about, and one of the reasons for bailouts and the whole growth of the Fed's book, and basically, you know, going on, you know, 16 years or whatever it is of quantitative easing policy, you know, that's something that is going to continue. And we're going to see the bigger banks get bigger. We're going to see them undercapitalized. And that will set up for a potentially bigger crisis where whatever the Fed can throw at it is not big enough in the farther future. But in the meantime, you can see mini crises in the financial system. And this is potentially global because there are relationships between, say, European banks and even US regional banks. There are relationships between JP Morgan and regional banks. So it's not to say it won't impact regional banks, the larger national banks or international banks. It's just that the result will probably be failures of regional banks, the taking over of them by bigger banks. And maybe like a Credit Suisse, you get a bank that fails, you know, a big bank that fails sort of in the process, or restructures into another form in the process. But the system continues as kind of is.
I think you've just alluded to a key point, because I know that there will be people that listen to this and detect that my accent is from England, and they'll be thinking and asking, well, why you know, if I'm living in England, for example, in the United Kingdom, why should I be so concerned about what the Federal Reserve does? Surely I should be looking at, you know, Bank of England, not just the Federal Reserve. But I think you've highlighted that just there with what you said about relationships, that actually a systemic crisis can just start in one place, i.e. the USA, you know, Japan, or whatever. And then because of the intricacies of the banking network and the banking system, the next thing you know, that it potentially the whole house of cards comes down. That's why it's important, I would say, that people need to understand not just what's going on at home, but also, you know, what's going on abroad, and start putting those pieces of the puzzle together.
Well, that's exactly right. And some of the trends, for example, even in commercial real estate that happen in the United States, I mean, these are global trends. I mean, there's certainly trends that have happened in the UK, where there is empty office buildings for the same reasons that, or portions of them for the same reasons that there were in the US. They were overleased. They were, you know, overexpensed, and people aren't necessarily going into the office as many days as they did before COVID. Or there's just cost cutting by, you know, the companies that had acquired them, and they don't need to have as much space, or whatever it might be. So a lot of these trends don't just happen in the United States. And another reason, for example, in the UK to be concerned, when we look at the size of the debt in the United States, the $35 trillion worth of debt, that's 7 times what it was about 10 years ago. I mean, it's a significant increase in debt. And what does that mean? Well, other central banks, including the Bank of England, buy US debt. What does that mean? It means the US owes them money, and in the process pays them interest on that money. The Bank of England has actually increased its portion of US treasuries on its books, while China, for example, has decreased its portion by nearly 50% in the last 10 years. So the UK, for example, is taking up some of the debt slack of the United States economy, as well as therefore a big hope that the financial system isn't going to fall apart by basically holding and growing its portion of debt. But the other thing is, we're just talking about capital and how the Fed is saying, well, you know, our big banks are fine, even though they're not, and we don't need to, even though we've actually seen their living wills aren't, we've actually said that. The Bank of England is now taking a look at the Fed saying that and saying, you know what, if you guys are going to basically not require as much capital to, quote, be taken out of the economy or taken out of lending or whatever to hold against emergencies in the future, well, maybe we don't have to, right? And so then you have a scenario, and the Bank of England did also bail out or significantly help through their version of quantitative easing banks in the UK, right? So then you have this version where if something happens in the United States and banks are undercapitalized, and let's say the Bank of England does what the Fed is proposing for its banks with UK banks, which is very likely because the Fed's doing it, and then something happens in the UK, then you have this what we call it contagion, or this effect where small ripples that are negative in the financial system and can even be negative for the economy for even a short period of time can have multinational impact. And so that's why you do want to be concerned, or at least if you're watching the Bank of England, why you also want to watch the Fed. If you're not watching the Bank of England because you simply have other things to do, that's fine. But why you would watch both is because of things like that.
I think that's a very good segue into gold. And again, a lot of price action we alluded to at the start of this particular podcast. I also love to give people solutions, and people might be listening to this, and there's going to be people that are listening to this that are very clued up. They know what's going on and they've got their plays in place. There's going to be some people listening to this that are very new to what we're talking about here.
Yeah.
And again, I'll link to another fantastic article that you wrote, and it's the US-China rivalry signals the green light for gold. So for people that might be getting a bit concerned about the current financial welfare of the world, gold offers something very good here. Go through what gold offers and why people should be looking at gold moving forward.
Yeah, so first of all, when the Fed did cut rates by 50 basis points, gold did spike immediately. And then, yes, it came back after Powell started talking. Usually when Powell starts talking, things come back and go down from where they originally spiked. This is just a thing. Everything that goes up when the Fed actually announces something actually goes down when he starts talking. It's just a thing. Gold, the market, etc. But the next day, we're talking, we get to the 19th, then when we're talking today before you air this, and things are back up again, and gold is back up at its historic highs again, and then it continues, a couple bucks off, but basically sort of retrace the down move after the spike. It's back up again, and the reason that gold has been on such a upward trajectory is multiple. One is because obviously, as anyone who follows gold, or even if you don't, the main thing about gold is that it quote preserves wealth. It acts as a safe haven against non-physical assets, non-physical currencies like the dollar, or really any currency. And it's been around a very long time preserving that. It's not like if you buy gold, you're going to get some huge return like you would have if you bought Nvidia 3 years ago. That's not what it is. What it is a long-term stable store, and has been proven of a diversification to currency, to the policies that impact currency, the dollar, and so forth. So we've seen an increase in gold over the last few years, but particularly over the last year and a half. One of the reasons for which is that central banks around the world are buying more gold. They have been. Last year, 2023 was a record buying of the sheer amount of gold by central banks. And in addition, retail buyers were buying more gold than they had before. More retailers starting to think of gold as a viable asset. And there's different ways to buy gold, whether that is in ETFs or physical or through miners that mine gold. There's multiple ways, and people are who haven't been sort of gold bugs, as they call it, for years, are starting to come onto this, as well as these major institutional shifts like central banks buying more. The piece I wrote with respect to China, who led last year the central banks in terms of new purchases of gold, and they are currently at historic highs for the percentage of gold that they hold in their portfolio, in the reserve portfolio of their central bank. But that percentage is still only under 5%. So the reserves that they hold, if they need to basically convert to money in any other currency or for any other purpose, only 5% of those are currently held in gold. Other banks, Russia, Poland, even the United States, who hasn't bought gold in forever, but their value of old gold has increased with the price of gold, have a higher percentage. And so if you look at China from a geopolitical perspective, why did they start buying gold? Well, to diversify against US policy, to diversify against the dollar, to hedge against trade wars, to be able to strengthen their own currency when they create national and international relationships beyond the United States, all of which has been happening. But now what we're seeing, and this just happened last week, and the United States generally, as it heads into elections, tends to get very negative on China. This is not new. This has happened in elections throughout this, certainly since the 2000s, but in general tends to happen. There were nearly 24 laws that passed the House, so one chamber of the United States government last week. They were all predominantly anti-China, from whether it was the economy or from a military perspective, a technology perspective. There were all sorts of bills that passed. Now, they haven't become law. They need to pass the Senate. The Senate is only in session for another 2 weeks before the election, and then it goes away until after the election. It would have to be signed by Biden, which can't happen until after the Senate. So it's not to say these bills are going to become law, but there was a significant bipartisan amount of them that came up. So if you're China, you're already looking at trade wars. You already have tariffs being raised and things going back and forth. You want to be a superpower. You want to continue to grow. You have this whole economic strategy. You are starting to buy gold, but you're actually below a reserve level that other kind of developing banks also have. What you're saying is, all right, well, these things are continuing to happen in the United States. That's not a mystery, but now we're moving from tariffs to Congress and acts and all sorts of other things that they are watching, because they would be. We need to diversify even more. So they're not going to go out and buy someone else's currency necessarily if they can buy gold. Now, gold has increased in value. Obviously, as we're saying, throughout this last year and a half, particularly this year, it's up 27, 28, whatever it is percent. And China did pause their buying for a couple months, but I think that was basically to reassess, is gold going to continue to rise at this pace? Are we going to buy more at this level because of this pace? And I think once the assessment comes in that, well, it's going to continue to rise, I think that's when actually the buying comes in. So I think that's when you buy at those highs and you push it up further, because you're saying, all right, well, it's not really going down. And now that the Fed has cut rates, and the immediate response was dollar went down, then dollar went up, and dollar went back down again. It's kind of even. Again, that's Powell talking. What we're just seeing is that if we do get an aggressive or even passively longer period of accommodative policy now, it's going to deflate the dollar. And that has the impact of inflating gold, the sort of real asset. So there's reasons why gold has already appreciated and reasons why it's going to continue to appreciate. And that was part of that piece that we just put out. It's not just about the Fed, it's also about geopolitical power and what's going on with respect to laws and tariffs and other things.
And this is why on the channel we love to advocate for Plan B, thinking outside the box, and just thinking about these things, because there's always going to be there are always going to be ways in which to protect yourself. I think that's probably a good place to end. I think we've covered a lot there. I would say the biggest spanner that we haven't covered is we have no idea what the Bank of Japan are going to do. So that there could all be chaos the minute this podcast comes out. We do not know what the Bank of Japan are going to do Friday morning. All of that being said, Nomi, before we wrap up, any other words of wisdom? Where can people find you? Anything else you'd like to add to what we've already discussed?
Yeah, thank you. And I think to an extent what Japan does will be noted, but what we are seeing again, the ECB cut rates twice, the Bank of England will likely cut rates again. And things are moving in that space. And this does, just to relate to our last point, also create an upward momentum push for gold and also for silver. And so people that aren't invested, you're not too late. I would say that you're not too late to get involved in different ways. And one of the places, certainly not the only place out there, that talks about all sorts of different ways is on my Substack, so PRINSIGHTS.substack.com, where we produce research on all these ongoing trends, as well as actionable strategies for people that want to follow them on an investment consideration basis as well. So that's where you can find us, PRINSIGHTS.substack.com.
Perfect. And as usual, for people that listen to this on the podcast, we'll put all the links. Head over to contrariancapitalist.substack.com as well. There will be a post about this podcast. All the necessary links will be in there as well. Dr. Nomi Prins, thank you very much for your time. I'd love to be able to start this conversation in 6 months or so and to see where we are in the world then, if that's okay with you.
Absolutely, I'd love to do that.